Hey guys, John Polemy here, Actionable Intelligence. Today is Saturday, October 26, 2019. First thing I wanted to get into was, again, I will note that weather is not climate and climate is not weather, but I did see on my Twitter feed consistent amount of cold weather records and snow records being challenged around the world. I did see up in Denver, in Colorado area, that several ski resorts are opening earlier than they've ever opened because of the tremendous amount of snow that they have incurred. As you well know, I am an advocate and of the sunspots being having an effect on the Earth's climate. The sun, I believe, is the primary driver, one of the primary drivers of climate on this planet. And we are now entering a period of low sunspot activity that correlates very nicely, if you look at the historical record, with lower temperatures. Maunder minimum, little ice age during the medieval times. These are things that you can look up and read about that aren't discussed at all. The CO2 narrative that it is the turning knob, the knob that controls the machine of heating on Earth, I think is going to be severely challenged with reality. As Ayn Rand said, you can avoid reality, you can ignore reality, but you cannot ignore the consequences of reality. And I'm not here to make a political point about it. I'm here to make money. And I'm a contrarian, and I've said before that I believe that climate change does happen both ways, heating and cooling. And I believe that we are going to be entering a period of cooling over the next several decades that is going to blow people's socks off. And it's going to really challenge our ability here on Earth to do many things, particularly feed the population. But that's for another podcast. I just wanted to mention that you should keep an eye on that. That's one of the reasons why I like aggregating and cultivating a great Twitter feed of people that are really watching this kind of stuff. So let's get into this week's podcast or video podcast, whatever you want to call it, the reality check. You know, a week or two ago, I did a video where I did a discussion about speculation versus investing. And I wanted to talk about investing a little bit and what we're trying to do here. I think, you know, in my newsletter and also just in these videos, I think I attract a lot of younger people that don't have a very high education on investing or don't understand risk. I think people are just looking for tips. And I recall back when I was younger, this is going back almost 30 years, I used to be involved in greyhound racing. I owned several greyhounds. They would race. I would occasionally go to some of the tracks that they were racing at to watch them perform. And I noticed there was a lot of really weird looking acting people. I mean, if you've ever been to a horse track or a greyhound track, there's a lot of degenerate gamblers, people that are addicted to gambling. I didn't really get into it too much. I just own the racing greyhounds, but they sell these, when you come into the track, they sell these tip sheets. You can buy them. I don't know who makes them. I guess presumably people that think they have an edge in determining the outcomes of these races. That appeared to me to be a lot more random than people think. But anyways, these degenerate gamblers would buy these things and then, you know, try to make their bets or superfectas or quinellas or trifectas, whatever they were trying to do. And I really don't want people to fall into that. I think a lot of people approach these markets the same way. You know, they're looking for easy money. They're looking for somebody to give them a hot tip. They kind of look at, for example, like look at the uranium market. You know, tell me the stock that's going to go up 10,000%. Well, I don't know. I don't know if any stocks will go up 10,000%. I don't know if the uranium market will ever recover. I mean, who knows? Can't tell the future. But I think, you know, people don't approach this whole endeavor sometimes with a lot of thought. I think that there's a lot of emotion and bias involved, which I've pointed out in the past in several other videos. So, speculation is, of course, trying to put the odds in our favor to try to predict an outcome in the future for capital appreciation. That's what I kind of look at as speculation. We are speculating that the supply demand dynamic in the uranium market will lead to higher uranium prices, ergo higher uranium mining stock prices, substantially higher. That's the short elevator speech, if you will. The same thing in the oil market. We are speculating that the underinvestment that has taken place worldwide because of the explosion in shale in the United States will lead to an eventual shortfall in oil supply because of that underinvestment. Ergo, oil prices will go up and stocks that are involved in the oil and gas exploration or services business will go up. Those are speculations. We are trying to take the current information and determine where in the future these prices will be, and then find a vehicle to participate in them. So with investing, and the reason I'm bringing this up is because, I am an investor also, along with being a speculator. I have retirement accounts. I mean, I'm 52 years old. I have prudence investing things that I do that yield me returns consistent over time and that are going to help me reach goals that I need to reach. I mean, I am in middle age, I'm approaching older age, and I have to have a retirement. I'm certainly not going to rely on the United States government and this Ponzi scheme they call Social Security. I mean, there's a lot of people that are going to be forced into that, and that's why you see 84-year-old people working at McDonald's taking the trash out and wiping tables. I don't want to be this person. So I do investing, and when I'm talking about investing, it's a long-term endeavor. I've spoken briefly about, I'm involved in timber assets. The reason I got involved in that is because I read a book about Otto von Bismarck, who was one of the first chancellors of Germany. He kind of got all the German principalities together and created the Prussian Empire, and the modern Germany kind of came from what he did. And the book was really written by his lawyer, I believe, or investment advisor, and he was really into timber investment. So I started researching it and started realizing, yeah, this is a pretty good investment over time. Why? Because as long as you don't have a forest fire or disease, which you can insure against these things, but these are pretty good investments. I mean, your trees are growing every year. You don't necessarily have to harvest them when prices are low. You can kind of wait till prices are higher, and they just continue to grow over time. Now, it's a long-term investment. That's one of the things I think I like about it is when I made the investment into some of these timber partnerships that I'm involved with, you can't get your money out. You're in it for the long haul. You're forced to take a long-term view. You are forced to let that compounding happen because you can't get your money out. Now, yes, you could sell to one of the partners, but it's not liquid. And that kind of forces you into a long-term mentality. And I think you see where I'm going with this with investing. Investing requires long-term thinking to compound wealth. What are we trying to do when we're investing in companies in the stock market? You're basically a owner of a partial share of that business. That's what you're doing. You're buying into that business. So you have to approach your investing like that. Would I be comfortable buying this investment? What does this company have prospects? Does it have returns to shareholders, me as a business owner, that are stable, long-term, and could possibly grow over time? And I want to align myself with people that are running the companies that are incentivized properly. And it goes back to what I said, what Charlie Munger says: show me the incentives, and I will tell you the outcome. I want to be involved with good businesses that have owner-operators. What does that mean? That means the management owns a substantial amount of the shares. The management's compensation is tied to the success of the company, not just cutting costs, chainsaw Al Dunlap, and coming in and cutting costs and making the earnings look good for a year or two, and then you undermine the business. This is what a lot of these Jack Welch disciples did when they fanned out from GE and went to Minnesota Mining and Manufacturing, 3M, Boeing. These are all disciples of Jack Welch. Go in, cut costs, cut corners, make the numbers look good, buy a bunch of shares back, don't invest in the business, and then you get your stock options exercise, and you fly off to wherever to live a life of leisure, and then you've undermined the business. We're not interested in that. We're interested in people that their compensation's tied to their large amount of shares that they own because they started the business or their family started the business, and they're aligned with us. So they're not just out trying to grow the business for the sake of growing it. And things like you know buying shares back, raising the dividend over time. This isn't flashy. This isn't hitting your dopamine receptors. It's boring. That's why people don't like it. But for certain things, like I just transferred my health savings account from a previous company to a new one, and the new one allows me to buy individual stocks. I can invest in mutual funds. They're little crappy high cost ETFs that they have internally, so they can rate me. Or I can just go to take it to TD Ameritrade, which I did, have zero commissions, and set up my own portfolio. So it made me think about this particular account is for my health savings account. So I don't want to just let it sit there at 0% money market funds or 0.8%. That's stupid. What I want to do is try to put it in something safe that's going to grow over time and provide me with a return and grow as I get older. It's obvious that as you get older, your healthcare costs increase. So it took me back to something I read that's Chris Mayer in his book, 100 Baggers. And then it made me look this up on the internet. And a guy named Robert Kirby back in the 80s, he was a money manager, advisor, or whatever. He wrote an article called The Coffee Can Portfolio. And briefly, what it does is it just talks about what he says at the start of the article is that you can make more money being passively active than actively passive. And you have to read the article. I'll put a link to it in the show notes. But the coffee can portfolio concept harkens back to the Old West, when people put their valuable possessions in a coffee can and kept it under the mattress. That coffee can involved no transaction costs, administrative costs, or any other costs. The success of the program depended entirely on the wisdom and foresight used to select the objects to be placed in the coffee can to begin with. And he goes on to tell this story of a client they had that kind of used this methodology by accident, and it ended up turning out pretty well. So they had a client. It was this woman. She was very wealthy. She was married to this guy that was a lawyer, and the husband managed the wife's finances. I guess maybe she had been married before and had some wealth. I don't know this whole story, but basically, this couple was married. The guy was an attorney, and he managed his wife's money. I guess it was a pretty good amount. And so what the guy did, or the lawyer, the guy that was managing the money, he died. So the woman came to Kirby and said, "Hey, can you help me out here? I got this portfolio. My husband put it together, and he, died. I don't know what to do." So basically, Kirby looked at it, and what the guy had done is he had every recommendation that Kirby's fund or Kirby's company had made for a stock. This guy just bought $5,000 worth of that stock and then threw the stock certificate in a safety deposit box. So if they said, "Hey, we recommend IBM," he'd buy $5,000 worth of IBM, get the stock certificate, and throw it in a safety deposit box and never look at it again. And he did this over many years, unbeknownst to his wife. This is how he did it. So when they got the portfolio, they saw certain things. They saw, okay, well, there's several companies that the guy put $5,000 into that are worth $2,000. Okay, that's one outlier of this bell curve on the low end. And then there were some that had done substantially better than returned on the $5,000 eventually. And the outlier was there was one company which was basically the precursor of Xerox Corporation. It had went from $5,000 to $800,000. So basically, what I'm trying to get across to you is that you just don't randomly just go out and buy stocks and throw them into a. What you can do though is you can look for companies that are owner operators that have return on equity, return on investment, consistent over time, that are run by owner managers, that are compounding capital, and that are undervalued. They exist out there, and you can put these things, you can buy them and invest in them in these businesses and let them compound over time. And, one of the problems with people nowadays is they're not patient. They just don't have the patience to let things run for the time periods and let capital compound. That's the whole thesis of the book by Thomas Phelps that I've went over, and I'll put a link to that video that I did before if you're a new listener, where I reviewed the book 100 to 1 in the stock market. He talks about this, or Chris Mayer's book 100 Baggers. Okay, but these things take time. They're not going to happen in 6 months or a year. So it goes on to say in this article, which I'll put a link to, it says, are we traders or are we really investors? That's the thing you have to ask yourself. He goes on to say, as a money manager, I have frequently looked at an investment decision that I felt had a high probability of success on a 3-year horizon, but about which I had many doubts on a 6-month time horizon. And, when researching this coffee can portfolio, I found several blog articles, and I thought one of the ones that I found was pretty good, which I will give a link to you. I don't agree with the guy's decision on the 5 stocks he picked for his coffee can portfolio, but in the beginning half of the article, he has some good comments, and this is one of the comments the guy had, which I'll put a link to the guy's article. He's talking about the coffee can portfolio here. The genius lies in its simplicity at protecting us from our own vices that include impatience, boredom, groupthink, herd behavior, and short-termism. These behaviors result in our selling great companies too early or just buying a smattering of things rather than making a significant investment in our high conviction ideas. The reality is that great investments often take a long time to play out and compound into multi-baggers. But you have to hold on for this to happen. So that really is a great comment. I'm really going to put that in my I save quotations on a sheet when I do my reading, and I'm putting this on here because that's exactly correct. You really have to understand yourself. You really have to be true to yourself. You have to look in the mirror and see who you really are if you want to be successful in this investing, speculating game. Okay? Our own vices and biases. Charlie Munger talks about this. I've talked about this in other videos. You have to purge this stuff from your thinking because it's constantly attacking your thinking. Okay? And that's why this coffee can methodology is good for when we're talking about investments. It's like Meb Faber says, most people don't have an investment plan. Most people don't have a plan for their life as it is. That's why they're not where they want to be in life. Certainly not investments. People I talk to people all the time. John, you know a lot about investments. What should I invest in? Well, what are you trying to do? What's your risk tolerance? Who are you? How much money do you have? How sophisticated and knowledgeable are you? These questions aren't even brought up. Give me a hot stock. I'm the degenerate gambler at the Greyhound track. Give me a hot tip. That's what people really want. They don't want to do the work. I mean, it goes back to what a lot of motivational people say, or a lot of people talk about. People are just lazy. If you don't want to do the work, if you don't want to try to understand yourself, if you don't want to create a philosophical anchor and determine what your values and what you really think and believe in, then how are you going to be successful at anything, much less investing? And that's the thing. Most people have no philosophical anchor about anything. They just react emotionally. That's why people are spitting in people's faces talking about politics, religion. They tell you, don't talk about politics, religion. Why not? I used to be a member of this group in Minneapolis, St. Paul when I lived there. And it was created as an outshoot of KC Research. We were subscribers to KC Research. And one of the things that Doug Casey had talked about is, with the advent of the internet and the growth of communications, people were going to be free to find similar associations with people that had their same values or believed in the things they believed in. So we created this file, if you will, which was a Robert Heinlein from one of his science fiction novels, a way of people kind of creating a society around common beliefs and values. And we had it up to about 20 people. We would meet monthly, and ostensibly it was to talk about investments, but we would drift off into all different subject matters, whether it was politics or religion. And we had some really great conversations and thinking going on there. And one of the rules we established about the original 3 or 4 of us that started the thing, and it grew pretty substantially, was that you can present any idea you want, no matter how off the wall it is, but you can't attack somebody else. You can't yell at them. You can't call them names. You can't froth at the mouth. We threw a couple people out. We asked people to leave, or people, maybe it wasn't that direct, but they were shown they didn't come back. Let's put it that way. So, you know, what I'm trying to say is that, most people don't think like that. They're emotional. They have biases. They don't have that philosophical anchor. They haven't sat down and thought about what they're trying to accomplish. That's why Meb Faber says you have to write down an investment plan. It doesn't have to be a 40-page thesis. It can be one page. This is what I'm trying to do. My kid needs to go to college. He's 6 months old. I have 17 and a half years to grow some money to help him or her. This is what I need to do. I need to achieve this return that's realistic, and this is the way I can do it. That's a plan. Not, I want to make money. Well, that's not a plan. That's an utterance. That's a non sequitur. So I think that this coffee can methodology is well thought out if you want to invest long term, if you want to compound capital. And, you should read this paper by this Kirby guy, and you should go back and read, Thomas Phelps' books, 100 to 1 in the stock market. You should read Chris Mayer's book about 100 baggers and what the commonality is around return on investment, return on equity, ownership. I mean, I have several companies. I'm going to create a branch in my newsletter for these type of portfolios. I'm going to create a portfolio that kind of shows kind of companies that I'm invested in, that are businesses that I have bought into, that I have confidence in are going to compound capital over time. They're not speculations, okay? Buying offshore drilling companies, hoping that the oil price comes back sufficiently, that's a speculation. That's not an investment. Buying junior mining companies because you think uranium's good, that's not an investment. That's a speculation. I'm talking about companies that are profitable, that are compounding capital, that are creating wealth and returning that to shareholders. That's an investment, like a rent house or like those timber investments I talked about. So I'll be talking about that more in my newsletter. I may give an example next week in the video. I don't know. I don't like to give too many things away because the paying customers rely on me, but to provide them with fresh ideas. So anyways, I just wanted to get into that because this is really important. I've really been building on this concept, I think, over the last few months and talking about it. And, if you're not going to sit down and really figure this out for yourself, I mean, everybody's journey is different. Everybody's different. I've talked to people that have zero risk tolerance. I mean, they will literally, if a stock drops 20, 25%, they'll start chewing their fingernails off and, why is this happening? It's like, well, did the original thesis for the reason that you bought this, is it still intact? Well, what do you mean? Well, why'd you buy the damn thing? Well, so-and-so said it was a good investment. So you don't even know why you bought the thing? I mean, I hear that a lot, guys. And, that's why I say, when I buy something, I sit down. What's the thesis? What's the reason I'm buying this? If the price drops and yet the thesis is still intact, I don't get excited. In some cases, I buy more. So just wanted to touch on that. A couple more things I wanted to go into this week, which I thought were important. We've seen this chart before. This is a more updated one. This is from Frank Holmes over at U.S. Global Investors. He has a pretty good blog that he puts out called Frank Talks, Frank Talk or something like that. But anyways, you can subscribe to it. But he brought up this week that the world's largest commodity fund called Blending Capital Management is closing after 50 years. And it was the largest commodity fund. And what I wanted to point out is that I remember Don Cox, who is, I think he doesn't really write that much anymore, but he's a famous prognosticator. He worked for BMO Capital Management, different investment management firms. He was a historian by trade, and he talked a lot about turning points and contrarian investing a little bit. But what he said about commodities sometimes, or a lot of these companies, was, sometimes when you see these type of things, those who know, he used to say this, those who know it best love it least because they've been hurt the most. So here we have a commodity fund that's closing after 50 years. It's the world's largest commodity fund. It's closing, Blenheim Capital Management, after 50 years. Now, it may just be because the CEO is retiring, but if capital was coming in and there was interest in the fund, they would just turn it over to another manager because these Wall Street people want their fees. So I think, we've seen this before. We saw last year, as a matter of fact, Frank Holmes points out in his article, in July 2018, Vanguard closed the $2.3 billion precious metals and mining fund. And then, that was at a low point in the market as far as gold and precious metals sentiment. And what happened? Well, we've had a rally up to $1,500 an ounce since then. And what happens, I think, a lot of times is things become so pessimistic. This is what you see at turning points. This is the point I'm trying to make. At turning points, you see these type of actions. I point out the greatest contrarian indicator of all time was when Gordon Brown, who was the chancellor of the exchanger in the UK, began selling the Bank of England's gold back in, I think it was 97 or 98 at $250 an ounce, because gold was a barbarous relic and all that kind of nonsense. That kind of marked the bottom. At maximum pessimism, this is the type of stuff you see. What do we see at maximum pessimism? Bankruptcies, mergers and acquisitions, consolidations, people throwing in the towel because why? Those who know it best, okay, or those who know it best have been hurt the most, okay? And that's why they get out. And that's, in many cases, is a tell and can be used as a way to help us in our contrarian thinking, if you will. So it's no guarantee that commodities are going to turn around, but this chart goes back to 91. Goring and Rosenschwag's charts go back even further. I mean, suffice to say, relative to equity prices, or stocks, if you will, commodities are undervalued. So if you want to buy something that's undervalued, you should be looking at commodities and commodity companies that are producing this. Now, it's not something that's going to happen in 6 months. We've talked about before. This is a longer-term cycle, cyclical. And, these things take time, but, the rewards are going to be great, I believe, when this thing turns, and it will turn. Another tidbit here, capital continues to dry up for U.S. shale. I pulled this chart off the FT. There's an article I'll put a link to. This kind of reminds me of the housing market. I remember back in, if you go back and search the internet, you'll find podcasts I did in 2006, 5, and 6 when I was talking about the housing bubble, well before a lot of people were. Maybe I'll try to drudge some of those up, and I like listening to them occasionally. I think if you search my name in housing bubble or something like that, you'll find some of these podcasts that are still floating around. But one of the things, I was having conversations with people, and they would say to me, "Well, John, if it's a bubble, why do they keep building houses into this bubble?" Well, if you're Lennar or Pulte or one of these housing companies, you're in the business of building houses. You're the management team. What's your incentive package? Building houses. You're not going to say, the thing to do if you saw that housing bubble coming, the prudent thing to do was to say, I see a housing bubble coming. This is not looking good. So what we're going to do is we're going to land bank all of our land. We're going to shut down building houses, and we're just going to try and cut down to the bare bones. We're going to shrink the office. We're going to wait for the recovery in housing because we see do you think that the board of directors is going to allow you to be the CEO? They're going to throw your ass out of there. So as long as people were willing to give you money and there was financing available and you're in the housing business, you're going to build houses because that's what you do. A housing company builder builds houses until he runs out of money. I mean, you see these rinky-dink people around your neighborhood or your city that are these small builders. That's what they do. They build spec houses because they get financing. The capital's there and they try to sell the house. I've known a couple of these characters, and they're always on the edge of a knife. They're at the end of a broken bottle all the time, trying to get the house done and flip it before, they have to incur too much interest expense. And that's what they do. So what do you expect these oil companies to do? Shale, it was so pumped up because of low interest rates. It was a bubble, Okay, they never made any money or very little money in cash flow. Okay, bankruptcies. This article talks about it. We've talked about it ad nauseum. And now the capital's drying up. If you're an oil executive and you're trying to grow production, that's what Wall Street wanted to see, growing production. It's the same story over and over and over, right? Back in the internet, eyeballs, traffic, just get traffic and eyeballs. It's the same thing in angel investing. I see it all the time. Hey, you're at $1 million in revenue. You need to get to 10 million so we can put 100 million valuation on this thing. Then you need to get it to 100 million so we can unicorn this thing and take it public. That's all people care about. What about actually creating a business that makes money? No one cares about that. Okay, because this financialized, commoditized financial market is all about, creating money for Wall Street and private equity and big shots. I mean, I hate to be that simplistic about it, but that's what it's about. No one cares about building a business. And now finally, the pot stock thing. I laugh. I made money in pot stocks before people even knew what the hell was going on in pot stocks. I got out because I knew it was a bubble. I'm going to buy Tilray at $200, $300 a share. I went over this last year. You can go back and look at my old videos. I was long gone before that even happened. Same thing in Bitcoin. I've admitted it. I bought Bitcoin $300, $400, $500. Okay, I kind of got it. Not many people got it. I sold most of my Bitcoin and my mining. Got out of mining Bitcoin at around 3,000 and 3,500 a Bitcoin. The darn thing went to 19,000. Am I mad about a 10-time return or 8-time return on my money? No. It's the same thing with shale oil. It's a bubble. Look at all the equities, or most of the equities of these shale companies. They're down 70, 80, 90% bankruptcy. Okay, the rig counts are collapsing. The frac spreads are going down. This is all being tracked. That's why I say Twitter is such a good tool. There are people that you can interact with on Twitter. This is their whole life. They track this stuff. And so what we're seeing is the money's drying up because the returns aren't there. You get into this bubblicious time. You can look here between 2014. It was bubblicious. Look at that. Look at all that money. Okay, and now it's shrunk by more than half from the top in 2016. Do you think you're going to be maintaining production out there in this oil patch? There's layoffs happening. It's shrinking. This is my whole thesis of why we think that. And what has happened is this whole nonsense, this circus that was going on in shale in U.S. with all these projections. It's going to 15 million barrels a day. It's going to 20 million barrels a day. We're going to swamp the world with oil. I mean, this is the kind of nonsense that happens at the top. You just see it over and over, the same psychology over and over. Bubblicious, bubblicious, bubblicious. Growing, it's going to grow to the sky. Boom, and then it blows up every single time. I'm not saying don't play these things, but you got to get in the front end of the thing. That's why you got to be you got to, as Don Cox said, you got to look at the page 15 story that's going to page 1. If you're buying the page 1 story, the people that made their money are long gone. So I wanted to point this out because I think there's going to be, oil demand is not going away. It continues to grow. It continues to stump these people that these countries around the world are growing, and these frontier and emerging markets. These people want what you want. And if your consumption in China is, 1 barrel or 1.5 barrels per person per year, and the average in the industrialized world is, 10 to 15, you can see where this is going. It's a spreadsheet exercise in Excel. So you have to invest lots of money to meet this demand. And I don't have enough time this week, but I'm going to get into it next week, where I found some pretty good information about, the major oil companies are not replacing their reserves. They've been told by shareholders, we want a return on our money. We don't want you to just go out and just spend all the money on replacing reserves. And at some point, that's going to be a problem. Now, quickly wrapping up, this is getting kind of long. I thought this was an interesting visualization. This is where somebody has went to the BP statistical review of world energy, which I think, is free to use. And people should be looking at, because it tells you the real story about energy demand, supply, all types of energy, just not hydrocarbons, nuclear, coal, renewables, the whole shebang. And I thought this chart was excellent. And what this Matt Ridley guy pointed out, an interesting statistic: China now burns more coal than all other countries put together. And they're still building more coal plants, thousands of megawatts. So this idea, coal consumption, I pointed this out in several videos before, has actually went up worldwide last year. Not a lot, but it did. Who's in second? India. You want to know why I'm bullish on nuclear power long term? Because these people are going to choke themselves if they keep burning coal. Would you want to live in that? The long-term viability of the Chinese Communist Party is partially tied to this. It's tied to creating more wealth, creating more jobs, and so people have that's why they're tightening things up there. That's why things are not as free as they were before. I mean, there's a guy, I need to find a link to the video. There's a guy, he's American, he's lived over there for like 15 years, and he's getting out now. He talks about how things were 10 or 15 years ago, and how, he could pretty much do whatever he wanted. Now he can't even buy a train ticket. He's getting hassled by the police. Motorcycles are being taken, all this crap. So what I'm telling you is that, the long-term viability or support for a regime, even a communist regime or a totalitarian regime, still has a basis in implicit support from the populace. And if you're choking and your one or two kids that you have that you're relying on to take care of you when you're old are having their health being destroyed by the burning of hydrocarbons with no pollution controls, creating this particulate matter, then you know why I'm a long-term bull on nuclear power, especially in the growth areas in Asia. Because this is, I told the story when I was in Mongolia in Ulaanbaatar. The Soviets built the thing between two mountain ranges. It basically sits in a valley. And when you get off I don't know if the new airport's open, but the old airport, you drive into the city and you'd pass these, I think it was thermal power plant number 4. I mean, they have these great socialist names. Thermal power plant number 4, thermal power plant number 5. It's huge and ginormous Soviet-style industrial complex with these huge cooling towers, okay? And just belching, burning coal, and providing the centralized heating. I mean, the city is one of the coldest capitals in the world, coldest cities in the world. They rely on this distributed heating system of hot water from these plants. That's why it's called thermal power plant number 1. Not only does it produce electricity, the thermal power from the combustion of coal is, circulated throughout pipes and heats a large portion of the city. But then you have all these people that moved in from the rural areas. They live in these yurts, these gers, and they're in there burning tires, trash, coal. I mean, you're walking down the street in January, February, you can't even breathe. It's like you're underwater. It's like you're sunk in I don't even know how to explain it. I mean, it's burning your lungs. And just being there for a couple weeks was, and I wasn't there during the main heating season. This was like at the tail end. And I can't imagine living in this every day. And what's the property damage? The attack on buildings and cars and machinery and people. I mean, if you don't understand why nuclear power is growing in the emerging markets, the United States has, 100 power plants. If you think the Chinese and Indians are going to have hundreds of these things over the next couple decades, if you don't see the potential here, I mean, you're not paying attention. And, you're not going to go from this from this amount of coal burning and the thermal power that it provides and the electricity it provides, and substitute that with solar and wind power. That just isn't going to happen. You don't know math and science in engineering if you think that. So that's it for this week, guys. I touched on a lot of subjects. I ran through a lot of things. I want to get you thinking, investing versus speculation. We'll have some more conversation about it, but that's it for this week. Run a little bit long. So appreciate your support. Enjoy the interaction in the comment sections, and we'll talk to you next week, guys. Thanks.